So we're starting with understanding markets and market analysis. We'll start with the basics. What is Forex? This question is very easy, and if you go online, you see the basic definition, which is what it is. Any other thing someone tells you is just funny, but the main definition of Forex is exchanging one currency for another, because Forex is short for what we call foreign exchange. So when you have the currency of one country and you want to go to the next country, you would have to change your own currency for the currency of that country in order to be able to purchase goods and services. So for example, now if you are in Nigeria and you have naira, and then you now go to Ghana to spend 3 or 4 days in Ghana, even to move around in Ghana, nobody will take your naira. Reasons being that it is not the official medium of exchange in Ghana. So even if you're able to make a transaction, you pay for a good, or you pay for a service. Let's say you pay for goods, and then you pay for a service using your naira. There is a huge chance that if you are being reported, you will be arrested, because it is not permissible. So that is why we have foreign exchange, because every country that has its own territory has its own legal tender that is used within that same country. So it is necessary for you to have foreign exchange so that you can avoid prison, and also be able to move around, eat food, in that country, and probably rent a hotel, or if possible rent a house and conduct business there. So you need that country's currency. So if you're not in your country, you must use if you're not in your country, whatever country you go to, or in whatever country you visit, whether it's for vacation or for business, you need that country's legal tender in order to transact businesses legally in that country. So that is why you have Forex. So now the thing there is, because of economics and because of central bank policies, there is all the currencies do not have one value, they vary. So you could go now and then change your naira to Ghana cedis, and whatever it is determined by market forces. So, and the market forces mostly is the economy of the country, the CBN decisions, and the political decisions that are going on in that country. So it determines the strength of the currency. So when you go there, you can now go there and they'll not tell you your one naira is equal to 35 35, I don't know what Ghana cedis, what their own minor denomination is. So so let's use the one I'm actually very familiar with. Let's say the US dollar. If you now go, as at this morning when I checked, as at the time I was recording this course, it's already in 1190 to 1210 range. So if you now go there, you now want to exchange your naira, so you have 10,000 naira, you reach there, you will take less than $10. So that is what Forex is. It's very simple, exchanging one currency for the other. So as Forex traders, what we do is we look for opportunities within the markets to be able to take advantage of the difference between when we buy a currency and when we sell it. So now let's look at it. Let me give you an example. Let's look at it like this. Now we have naira at 1200. Let's call it 1200. And our government is not making any positive decisions, and probably they are even looking to borrow more money, looking to print more money from the central banks. What will happen to the naira is the naira will lose value, lose way more value. So if you buy at 1002 now and you say, okay, with what this government is doing, you are anticipating that the naira could go as high as 2000 to 2300 by the end of 2024 or by middle of 2025. If it's that slow, well, let's just say that that is what you project. You now buy at 1000 to, let's say you have like 10 million naira, which is roughly 9000 plus dollars, right? And then you are able to change it to dollars, and you are anticipating that you're going to sell that same dollars you're buying now by mid 2025, when probably your analysis that, okay, this dollar I'm buying is going to hit so and so naira by mid 2025, and let's say it projects, it works. So the difference between when you buy and when you sell becomes your profit. So if on the other hand the government starts making decisions midway, and then the decisions become very good, and now the naira decides to gain against the dollar, and you now, by the end of by the time you were speculating, let's call it by mid 2025, the dollar to naira rate now drops to let's say 800 or 750 to $1. You will lose your money by the time you are withdrawing it. So it's for you to understand exactly what is going on. That is how forex works, and that is what we traders do. There are people who do this on a daily basis, they call themselves day traders. There are people who do this on hourly hourly basis, on 15 minutes basis. We call those ones scalpers. And then there are people who do this for a period of time, 3 days, 4 days, 5 days or more. They call them swing traders. And there are people who do this for who trade for, let's call it 1 year plus. Like, as I anticipated, I'm calculating now because I'm recording this thing in the first week of 2000, the first week of January 2024. So, and I'm giving you an example of mid year so mid year should be around June 2025. So people like that are people who call position traders. So this is what it is, this is what forex is, and this is how to trade it. So when we come to the next thing, who controls the market? A lot of things, a lot of factors are here. Number one, the people who control the markets, the government and the CBN, because those are the people who give you the factors that would determine whether the economy will do well or not. So these people are the ones that will actually drive and control the market, the central bank especially. So central banks of each country actually controls the market. Just as easy as that. Don't bother looking for any other thing. If they say, okay, we are going to have a rate hike, that's when people like me and you who are traders will be like, okay, this country is having a rate hike, this other country is having a rate cut. What are we going to do? We are going to back the currency that has a rate hike, but we'll have to wait for the central bank to make that decision, and then we'll now know where to put our money long term. So they control the market. All we as traders do is just follow what they have to say and be doing it. Then in the course, I'll break this down further for those who will be able to buy the course. I'll break it down further and tell you the roles each one plays. But first of all, you have the government, the central banks, and then you now have large speculators, you now have merger and acquisitions, you now have hedge funds, you now have retail traders. These are all participants. They don't control the markets, but when you see price move, everybody is taking a position in those price movements. So all these people I called now are the ones who will be taking part in, who are participating in it. But the real people who are really in control of things are the central banks and the government. So what affects the movement of price? Number one, interest rates. Very important. That's what most people look at. Number two, the GDP. Number three, the inflation rate. These are the things that affect the price of the movement of prices. And of course, those are the macroeconomics. Those are the things that the central bank looks for before they take their decisions. Then for we who are traders, we look at both the fundamental analysis and the sentimental analysis. Sentimental analysis is what the market perceive. So a government can now, a central bank governor can now come and say we are not cutting rates, and the market perceives that not cutting rates as a bad decision for the central bank. The same way George Soros saw the decision of the Bank of England many years ago as bad, despite the fact that they felt it was good. But George Soros felt it was a bad one, and he took a stand against the British pounds, and he won. Inevitably, even his trades, his decisions made the central bank to say, okay, what we are doing is wrong, right? So these are the things that affect the movements of price: the sentiment of the trader and also the economic factors. Then when we're talking about market and price analysis, it's simple. A lot of people, when they're talking about market, they're talking about price action, talking about candlesticks. That is not what we're going to talk about here, because in reality that is not it. And what I call those things are price analysis. When it comes to market structure, order blocks, smart money concepts, Elliott wave theory, whatever it is that has to do with technical analysis, I call that price analysis. So but when you're talking about the market itself, you're talking about what is driving that asset class that you are in. So if you're able to understand what drives the market, if you're able to understand the fundamentals, if you're able to understand the sentiment, then price analysis is the last thing you will look at. But many people teach you price analysis first, and they don't teach you anything about the market. In fact, many people don't know what is going on in the market. So if I bring it down now to how we analyze things, you find out that even when in my course where I teach, right, I break down the classification of currencies based on commodity currencies, different kinds of currencies. So you will understand exactly what you're trading. That is how you understand the market. So if you're trading a commodity currency, what are you trading that commodity currency against? Is it against another commodity currency? And then if you're picking it, why are you picking this commodity over this other one? Why do you feel that this one is going to do better than this one? That is how you check. And then when you are sure, okay, this is the reason why you're entering this trade, you come and look at price. When you look at price, you be like, okay, what has gone on in the chart? Has it gone up for some time? Has it come down for some time? So if your analysis is a buy, you will now look for, okay, how long has it sold off for? If it has sold off for some time, you now look for opportunities to buy. But if the thing is still in a buy, you have to wait and be sure, okay, what's the space between now and the next level I am looking at in price? If it's wide enough, you take it. Okay, if you are someone who uses stop loss, you be like, okay, what's the range between the price now and my stop below a certain level? If it's too wide, you let it go. It's just as easy as that. So we'll continue in the next video. Thank you very much.